as always. So let's continue where we left off, and actually I have no clue because there was actually quite a delay between me recording the first session and the second one. But yeah, let me jump right into the lesson number 1, because what we did before was kind of just like the prerequisite and the big picture of, what changes when we are in that 6-figure, multi-6-figure, maybe 7-figure territory, right? The game gets a little more nuanced, little more stable, but we also have to, understand all of these details. And at this point, we should be very, very competent investor, right? Because what's the name of the game now? Well, scaling with purpose. So once you cross into 7 figures, the game changes. Not just in how you invest, but why. Up to this point, your goal was clear. Grow, get to 10K, 100K, first million, right? The mission was accumulation. Now it gets more nuanced. With serious capital, there's a new question. What do you want this money to do for you? Do you want to aggressively grow it to 10 million plus? Are you optimizing for optionality and long-term autonomy? Or are you starting to prioritize safety, future income, legacy? Each path requires a different lens, not in how much you hustle, but in how you allocate. Multipliers think in asymmetry. You're still on offense. You want to 5x, 10x your capital again. That means taking concentrated bets where you have an edge. You're hunting for companies with massive total addressable market, founder-led energy, and product market fit that's just hitting escape velocity. You keep cash ready for downturns, not to cushion, but to attack, right? And actually this year, 2025, was a great example, right? The dip in April, perfect opportunity for more opportunistic, more aggressive capital allocator, right? The markets, as of now, July, are slightly green on the year, but nothing spectacular. I think we are like 7% up or something like that. Competent capital allocator did 20, 25, 30%. Use the dip in April as a springboard. So, and exactly, competent capital allocator welcomes volatility. Because you understand the payoff. You're not just being early, you want to be early. As long as your research is sound, you'll sit through pain because the reward is worth the discomfort, right? So sure, so many people back in April are panicking like, hey, what's going to do? Is this going to be crash, crazy? And lots of, panicans, right? They were just like, what's going, the sky is falling. Like, no. Like, that's exact opportunity, right? And we have to be able to seize it. Or preservers think in structures. Some people are shifting towards stability, not just compounding, but protecting. You're focused on resilience, wide moat companies with stable cash flow, dividend payers, lower beta assets. Maybe even holding part of your portfolio in alternative structures, real estate, private equity, holding companies. You still care about your returns, but you're optimizing for longevity. Less about what could 10x and more about what won't blow up. Your time horizon stretches even further. You're thinking about intergenerational wealth, optionality, and long-term capital efficiency. The key is clarity. Define your purpose and then deploy it like it matters, right? So, if we want to end somewhere, we have to understand that goal. What's our goal, right? To be able to get there. We cannot just we are hearing about some companies, there is someone talking about this company here, and someone on CNBC or someone on YouTube or someone on X, they talk about this company, let me buy a little bit of the company and then a little bit of this. That's how many people simply end up with portfolio that's like cake with all of the flavors, right? It's just a spliced up without any purpose. No, we have to take a step back, define our portfolio structure, what makes sense for us, right? And risk and return at scale. At the 7-figure level, risk is no longer a theoretical trade-off. It's real capital at stake and real opportunity cost with every move. You're not thinking in terms of high risk, high return, like a textbook. You're thinking in terms of calculated asymmetry. Is this risk worth it, given my capital base, time horizon, and opportunity set? Risk isn't volatility. That's also an important thing that people, many times just gloss over or use interchangeably. But volatility is not the risk. The risk is the chance of permanent capital loss. It's dilution, misaligned incentive, poor execution, It's buying at the wrong price, getting stuck. Return isn't just a number, it's a function of scale, duration, and conviction. 30% return on 10K flyer is cute. A 30% return or 700K position is a different game, which is why risk has to be understood in context, not just emotionally, but structurally. At this scale, we can no longer afford the mistakes, right? We're not playing with a couple thousand, right? At this point, we have to fully understand what we do. Your tolerance isn't just a personality trait anymore. It's strategic. It's tied directly to your capital intent, whether you're optimizing for expansion or defense. Every dollar has a job. Every risk needs a reason. At this level, your job isn't to avoid the risk. It's to own it intentionally, right? So we have to understand the gravity of the situation at this level, right? Because every decision for a portfolio, like these decisions, especially when we extrapolate into the future, right? Because let's say you have a million portfolio. Well, sure, that's million that's inside. But also that million in 5 years can turn into 3, 4, 5 million, right? So basically those decisions inside the portfolio at this point are 5 million decision, right? That's the magnitude. Not the current value, but that future value that's expected, right? Because those decisions mean, is this portfolio from 1 million going to 3 million or going, let's say, to 1.5? The delta between those decisions is suddenly in millions, right? Every decision is worth of millions. Advanced asset allocation. Beyond 6 figures, you're trying to deploy capital in a way that actually matters. And that means facing an inconvenient tension. Do you want to concentrate for outperformance or diversify for durability? There's no universal answer, but at this level, your structure needs to serve your intent. Concentration builds wealth. It's how most 7 and 8 figure portfolios are built. 1 or 2 big winners with heavy weighting. Palantir, Tesla, Nvidia, Netflix, Apple, you name it. Many people became wealthy through one concentrated bet. The math is simple. Concentrated bets on asymmetry move the needle. Broad exposure doesn't. But resilience keeps you in the game. When portfolios get bigger, the emotional stakes are higher. Down 10% on 10K is annoying. Down 10% on 1 million is 100K. Suddenly the sleep test becomes real. So the balance is this. You want enough concentration to outperform, but enough resilience to survive the parts of the cycle that punish conviction. So to put it into a practical framework, at least that works, for a broad spectrum of people. Core 60 to 80% of high conviction, long-term holdings we understand deeply. These are the pillars, the bedrock of the portfolio. Opportunistic 10 to 30%. Asymmetric ideas, size these smaller, knowing they're riskier. And cash 10 to 20%. Dry powder, strategic liquidity that lets you act decisively when the world panics. At this level, your capital structure is like a machine, and every part has a function. Some parts generate, some parts protect, some wait. Your job is to build the machine that aligns with your temperament, your goals, and your edge. Not too tight that you crack, not too loose that you underperform. That's the real skill. And number 3, the edge of time. One of the biggest edges you can have in this game is also the simplest. Time. Most people treat the stock market like a casino. They're glued to screens, refreshing their portfolio every 10 minutes, trying to guess what happens tomorrow, next week, next quarter. They're not investing. They're speculating on noise. But here's what they miss. Real value doesn't appear overnight. It's built. Every single day, the companies you own are out there, operating, selling products, providing services, building infrastructure, strengthening their brand, improving their margins, expanding their reach. You might not see it reflected in the stock price today. You might not see it next month, but under the surface, something is happening. Value is being created in the real world. It's not just the ticker symbol on the screen. It's the people, systems, processes, assets. When you stretch your time horizon long enough, the value starts to compound. Factory, software, distribution, partnership, customer loyalty, the intellectual property, it all adds up. The company becomes bigger, stronger, more profitable simply by continuing to do what it does best. That's time arbitrage. The ability to look past the noise and see what others can't, because they're too busy staring at the 5-minute charts while you're thinking in 5-year increments. Over time, the gap between perception and reality closes. Speculation fades. Fundamentals win. That's why we don't trade. That's why we don't obsess over day-to-day moves. Because we understand that the real game is played over years, not days. The longer you can stretch your time horizon, the fewer competitors you have. Very few people have the patience to wait while value silently accrues behind the scenes. That's where the money is. Bell curve stages. Stage 1, start the engine, right? Starting from the very little into multi-millions. At the very beginning, every dollar is earned. Your savings rate and discipline matters more than compounded annual growth rate. You're not compounding wealth. You're building the base that will, right? More firewood on the fire. Stage 2, let the machine run. The portfolio starts to take over. Compounding begins to do the heavy lifting. Patience, clarity, and staying the course matters more than the tweaks. Stage 3, capital as leverage. Now your wealth moves the needle. One bold allocation, one right decision, and the absolute numbers get staggering. Discipline matters more than effort. This is where legacy starts to form. Heavy. But yeah, that's the name of the game, right? From 7 figures, and it's not what it used to be, right? I mean, the million at this day and age is just a starting point, right? So we have to keep scaling into that, multi-7-figure territory. Do it with intent, do it with gusto, and make ourselves proud. Appreciate you.